Hello students, hello participants, how are you? I hope you're all fine and in best of your health. So welcome to the practice to pass sessions. And today we are here with the day one for the financial management session. So I welcome you people again to this session. So today let me tell you a bit about how we will proceed with the sessions. So first of all, let me tell you that we will be uh, on the day one we'll be doing investment decisions, and on day two we'll be doing working capital management. On day three we'll be doing financing decisions and cost of capital. On day three we'll be doing risk management, and on day five we will be doing business valuation and other areas. So my name is Kaid Johar, and I am teaching financial management since the year 2004. So it has been around 15 years since I'm teaching financial management. I also teach other subjects as well, financial reporting and financial accounting and management accounting, and SBR as well. So uh, participants, today we'll be starting with investment decisions. But before starting that, I want to tell you about the examinable topics in various sections of the exam. So we are having three types of sections and three types of questions in the exams. So our section A encompasses objective type questions, and there will be 15 objective type questions in section A, and any area of the syllabus can be examined in section A. In section B, we get three scenario type questions, and each question is of 10 mark, right? And in each question there will be 5 2 mark question, objective type question. And in section B also, any topic in our syllabus can be examined, right? So in section A and B, you shall be prepared to answer any topic of our financial management syllabus. But in section C, there are 3 areas which will be examined. And in section C, we have 20 mark 2 questions. So section C comprise of total 40 marks, but we'll be having 2 questions in it of 20 mark each, and 3 areas of our syllabus can be examined in that section C. And those 3 areas are investment decisions, second is financing decisions, and the third one is working capital management. So these are the 3 areas which can be examined in section C. So uh, in today's class we will be doing investing decisions. So let me tell you how we will proceed, how my lecture will proceed. So students, you will be looking at the screen, and you'll be observing an Excel sheet on your screen, and I'll be writing on this Excel sheet, and I want you to please keep on writing on your notebooks as I write on this Excel sheet. So on the left hand side you can see the questions, right? So let me show you that on the left hand side there are questions appearing on this Excel sheet, and this question 1 is a section B type scenario type question, in which there are 5 objective type questions, right? And then you see the question 2 is appearing on the screen, then comes the question 3. So likewise the questions will keep appearing on the left side of the sheet, and on the right hand side where you can see the cells, over there I will be writing the answers, right? So you can keep noting the answers from the right hand side, and I also want you to keep calculating and keep a calculator with yourself, so that you can keep the number work also on the keep doing the number work also on your calculators. So in today's class in investment decisions, let me give you an important tip that students usually do more practice of a few areas in investment decisions, which I want to emphasize that there are other topics as well which you have to focus on other than those few areas. So what few areas on which the student do work a lot, and on what areas they do not work at all, or they work less, due to which they lose easy marks. So what happens that students in this section, investment decision, mostly work on the investment appraisal, the NPV work, the net calculation of net present value, inflation, taxes, and these types of things, right? And they work on internal rate of return and pay calculation of paybacks. But they miss a lot. They do not work on asset replacement decisions. They do not work on the capital rationing area, right? And they do not work on the lease or buy decisions. So these are also some important areas in this sections. And further, students also work less on the risk and uncertainty portion, the investment decisions involving the risk and uncertainty portion. They do not work on that area. So I want you people to work on the investment decision area, the NPV, the IRR, the payback period, the return on capital employed area, plus also work on these areas, asset replacement and the sensitivity analysis, expected value. This is covered in risk and uncertainty, and plus also work on the capital rationing area and the lease and the buy area. Lease and buy area is sometimes covered in, can be covered in financing decisions as well. So the top questions being selected by me cover all the areas which I have just told you about. So let's start with our today's question. We'll be doing a lot of practice work, and also I'll be giving various tips to you people at various moments in this workshop. So keep with me so that we can learn together. So students, our first question, you must have got the handouts as well for today's class, day one. So you can refer to the handout. There will be a worksheet on which you will be having, you can see these questions which are appearing on the left side of this Excel worksheet. So students, I will be giving you some time before I start a question. So I'm giving you a few minutes to read this question one, which is Bell. So students, please go through this question Bell. I'm giving you a few minutes, around 4 to 5 minutes to read this question out. Then I'll be starting to solve this question. So please go through this. Okay, students, let's start with requirement A of this question 1. What the question asks is, what is the DING's money discount rate? So, students, the formula for the money discount rate is as follows. It is 1 plus R. R is the real rate of return, multiplied by 1 plus I. It is the inflation rate, minus 1, multiplied by 100. This gives you the money discount rate. The real discount rate is the rate which is not adjusted for inflation. When we are making an investment decisions, we calculate present values of the cash flows. So when we calculate present values of the cash flows, we first adjust those cash flows for inflation. That is, we calculate the cash flows, the receipts, and the payments which will occur in the future after taking in account the inflation rates. So we inflate those cash flows. Once we inflate those cash flows, then we calculate the present values. So we will have to calculate the present values using the money rate. We cannot use the real rates. So we have to convert the real rates into the money rates. So first, this question requires the money rate. So the real rate being given in the question is 5%. So first of all, we will calculate 1 plus R. R is 5% divided by 100, which makes 1.05. We will multiply this 1.05 with 1 plus inflation rate. So inflation rate is a general inflation rate, an average inflation rate in the whole market. So an average inflation rate should be considered. The average or the general inflation rate which is being considered or given in the question is 2% over here. So 2 divided by 100 will make 0.02. So 1 plus 0.02 is 1.02. Multiply 1.05 with 1.02, and then deduct 1 from it, and then multiply by 100. So this gives you the money rate of inflation. So the money rate of inflation in this question is 7.1% for DING. So the figures being picked from the question are as follows. I've picked the real discount rate from here and the general inflation rate, which is 2%. So this is where I have picked the figures from the question. Okay, students, let's move ahead to the question number 2. What is the present value of Dong's last payment that will be made in 4 years time? So according to the question, Dong is going to pay 4 annual lease payments, and these payments are going to increase at a rate of 4% per annum. As you can see in the pink shade, that the payments will rise by 4% per annum. Okay, I hope you can see the screen now. Are you being okay? Okay, thank you. Thank you. Okay, let's continue, students. So let me tell you again that in the requirement B, requirement B is asking for what is the present value of Dong's last payment that will be made in 4 years time. So moving on to the question, I have marked with pink that Dong is going to pay 120,000 per annum, and the first payment is of 120,000, which will occur in 1 year's time. So students, the first payment is payable in 1 year's time, which is of 120,000, and then the next payment which will occur in the second year, which will rise by 4%. Then the third year will rise by further 4%, and the third year payment will rise further by 4%. So the fourth year's payment, which is asked in the question, would have increased by 4% 3 times, right? So we will increase the 120,000 payment 3 times until the fourth year when the payment will occur. So let's do the working. So it's 120,000 multiplied by 104%, multiplied by 104%, multiplied by 104%. So this gives you 1,34,983.68. You can keep computing on your calculators to arrive at the answer. One more way of doing this is that we multiply 120,000 directly by 1.04 and then put a power on it, 3. So if you put a power 3 on it, we get the same answer. This means we have multiplied 120,000 3 times. So this gives you 1,34,983.68. So if we round this answer, this makes 134,983, and now the question requires that we need to know the present value. So in the next step, 134,984 will have to be multiplied by the discount factor, which is 1.08. 8% is the discount rate for this project. So 1 plus r to the power minus n. So you have to calculate the present value of this payment, which will occur in 4 years time. So first I calculated the annual payment which will occur by the end of the 4th year, and then now I am calculate the first I calculate the amount of the payment which will occur in the 4th year, and now I am calculating the present value. So we will take it back for 4 years. So 1.08 to the power minus 4. This gives me the present value amount. So the present value amount is 99,217.27, and if we round it off, this makes 99,000. So our answer over here is 99,000 to the part B. Okay, students, now moving on to the requirement C. What is the net present value of the Merrilees project? So let's calculate the net present value of the Merrilees project. So according to the question, let me show you the cash flows first. So in the Merrilees project, Merrilees is considering investing 1 million in a project which will produce the following annual outflows and inflows. So these are the cash outflows and inflows which I am highlighting in pink for the year 1, 2, and 3. And according to the question, it is expected that outflows are expected to rise by 3%. So first we will inflate these cash outflows and inflows by 2% per annum. And the money's cost of capital of the Merrilee division is 9%. So let's calculate the inflated cash flows first, and then we will calculate the present values in order to arrive at the net present values. So now we will work on the requirement C of this question. So let's work on inflows first. So the first inflow occurs in year 1, then year 2, and then year 3. So in year 1, the inflow amount was 2,000, and this inflow is expected to increase by 2%. So this gives you 2,040. In the second year, the inflow amount is 3,000, and then multiplied by 2%, but you will multiply it at it 2 times, because the cash flows being given, the inflows are being given at the time of the decision. So for the first time, the cash flow will increase in year 1, and then again it will increase in year 2, means that the cash flows will increase 2 times. So you have to take the power 2, so that there is a 2% increase 2 times in year 1 and then again in the year 2. So 3,000 multiplied by 1.02 to the power 2. This gives you 3,121. And then the third year, the cash flow is 2,000, but this is in current terms on the decision making date. So the cash flow will increase 3 times at the rate of 2%. So over here, the power should be 3. So the amount will be 2,122. So 2,122 will be the inflow amount in the year 3. Then, okay, Bilal, I'll be showing you the question in a minute. Okay, moving on to the outflows. So the first outflow is of 1,800, and the outflows are expected to increase by 3%. So in year 1, the cash outflow will become 1,800 into 1.03, which makes 1,854. In the year 2, the outflow amount is 2,500. So it will increase 3% two times. First time in the year 1 and then again in the year 2. So over here, you will put a power of 2 and you get 2652 in year 2. In year 3, 1,500 will be the outflow amount, and it will increase by 3% for 3 years. So we'll put a power of 3. So the amount, this amounts to 1,639. Now, in the year 0, there will be an outflow of the initial investment, which is 1,000. Now, here we get the net cash flow. Net cash flow is receipts minus or inflows minus the outflows. So before moving on to the calculation of the net cash flows, I will be showing you the question again because some people have requested to show the question again. So there you are. You can see the question. The merrily part is appearing on the screen. Okay. So moving back to the answer now. Okay, students. So the net cash flow amount for the year 0 is the initial investment, which is 1,000. This will be minus because there is an outflow. In year 1, the net cash flow is 186. In the year 2, the net cash flow is 469. And in the year 3, the net cash flow is 483. Then we will multiply this with the discount factor, which is 1 plus r to the power minus n. So in this case, the discount rate is 9%. So you will be taken 1.09 to the power minus n, which is in years. So in year 0, you will take power 0. So the discount fraction will appear to be 1. And then in the year 1, 1.09 to the power minus 1. So you have to take up to 3 decimal places. These fractions will be taken up to 3 decimal places. This is the exam convention. So 0.917 will be the fraction, and then in year 2, 0.842 will be the fraction 9%, and in the year 3, 0.772 will be the fraction. So in year 3, I have taken 1.09 to the power minus 3. Okay, so now multiplying the net cash flows with this discount fraction, the present value fraction, you will be arriving at the present value. $1,000 multiplied by 1, and then 186 into 0.917, $469 multiplied by 0.842, and then finally 483 multiplied by 0.772. So students, this gives you the net present value, which is 61, and which is negative. The net present value is negative, minus 61. So the correct answer, yes, you are right. So the correct answer to this question is D. NPV is minus 61. So students, I'm giving you a 2-minute time to note this out, and then I will be moving on to the next requirement, the requirement D. Okay, students, let's proceed ahead. Requirement D. When considering risk in project appraisal. Yes, I'll tell you a bit about the simulation. If you have a question, students, you can write on chat, right? So I'm continuously looking at chat. Sometimes when I'm solving a question, I sometimes do not look at chat because I'm busy in doing solving questions. So you have to wait for a few minutes. So please wait till then. Okay. Yes, Mohammed Shahin, I'll show you that page in a short while. So you'll be able to see the bifurcation of the topics. Actually, inflation, let me first answer to the question of Mohammed Nadeem. Nadeem, I have used 3% inflation and the 2% inflation different, as the inflows and outflows inflation rates are different in the case. Like you may have the selling price inflation to be 2% and the material inflation to be 3%. So that's why I have taken separate inflation rates. So as per question, the outflow rate is 3% inflation, and the inflation rate for the inflows is 2%. That's why I have taken a separate inflation rate. Okay, is it okay now? Okay. So if you are given a separate inflation rate for separate items of cash flows, you have to use separate rates, right? But when you're calculating the money rate, then you have to use a general inflation rate, because money rate is a rate which prevails in the market. So in the market, people don't know that in the industry how the inflation rates of the cash flows of various industries will move. The interest rate or the cost of capital is same for all people in the market. That's why we use a general inflation rate, on the basis of which the inflation rates are adjusted. Okay, let me answer another question over here. Okay, why we use a power of 3? Why did I use power of 3? I use power of 3 because 120,000 was the cash flow for the year 1, right? Then the next inflation will occur in year 2, right? So one time the inflation occurred in year 2, then in 3 second time, and then year 4 third time. So it occurred for 3 times, right? If they would have given you the cash flow in year 0, I would have taken power 4. Okay, Vivek, is it okay now? Okay. So students, usually in the workshops, we do a lot of practice, and we suppose that to some extent you would have studied the syllabus in a good manner. And obviously we do discuss a bit of concepts, but not much, because then we will obviously in 15 hours we can't do all of the concept work, but we do some concept work in it, and or we do practice also. So you have to concentrate on both in the class, in this session. So you'll get both of the things in this thing. Okay, so let's move ahead. See, let me tell you about a bit about the project simulation. That when considering risk in the project, what is the main advantage of using simulation to assess the appraisal? So what happens that let me tell you a bit about simulations. What are simulations? Simulation is a technique in which we can change various variables like selling price, and we can change variable cost, and we can change the fixed cost at the same time, and we can check that what the NPV of the project will happen to be if in future these variables change. So this is used when we do not know exactly that what the selling price, the fixed cost, the cost of capital, and the variable cost are going to be in the future. And obviously future is uncertain, and there is going to be some difference in actual cash flows compared to the estimated cash flows which we estimate or at the time of making decisions. So in order to know that if the cash flows change, what happens, we use simulation technique. So instead of a simulation, if we use sensitivity analysis, in sensitivity analysis, it accounts for only one variable, right? So instead of sensitivity analysis, simulation technique is a lot better technique, right? So the main advantage of simulation technique is more than one variable can change at a time. So this is the main technique due to which this simulation technique is found to be a distinctive one, uh, other than the other techniques like sensitivity analysis and expected values and these type of techniques. So usually in case of risk and uncertainty, we do 3 types of techniques. One is sensitivity analysis, the other one is the expected value, and third one is the simulation technique. So this is the correct answer to this question. B. Yes, students, there is a question that any tips, suggestion as to how we should manage our time in the exam. I'll be discussing that this after this question number 1. So please be together until then. Okay, so let's move on to the part E of this question. Okay, so the part E requires, is it possible to have a negative real discount rate to apply to the cash flow estimates made in the current terms when making investment decision? So what do the question ask, that if our cash flow is prepared in real terms. Real terms means that our cash flows are prepared in the prices on the decision making date rather than on the future date with inflation. So we are not calculating the present values using the inflated cash flows, right? Inflated cash flows are also known as money cash flows. So if we use a money cash flow, we will be using a money rate. But if we are using a real cash flow, we will be using a real rate. So over here, what they are asking, that is it possible to have a negative real discount rate? So obviously negative a real discount rate will be applied to a real cash flow first of all. And they are asking that can a real discount rate be negative? So it's yes, it can be negative. When can it be negative? When the inflation rate is higher than the real cost of capital. Now what happens that if your real rate is 6%, right? The opportunity cost is 6% and the inflation rate is 3%, right? So the creditor will ask for, or the investor will ask for a rate which is greater than 6%. Why? Because there is a 3% inflation rate. So the rate increases if the inflation rate is uh, suppose 3%. But suppose that if the inflation rate is negative, the prices of the products in the market are falling, what happens then? So if the real rate is 6% and the inflation rate is -9% or -7%, what happens then? Then the cost of capital will get negative. The real cost of capital gets negative if the inflation rate is high. So the money rate increases due to, let me repeat again, if there is a positive inflation rate, the money rate will be greater than the real rate. But if the inflation rate is a negative, then what? Then the money rate will be getting lowered, and then it can get negative if the inflation rate exceeds the real rate, discount rate. So over here in this question, the answer is yes, and the reason is it will happen if the rate of inflation exceeds the money cost of capital. So if the rate of inflation exceeds the money cost of capital, and you put in the formula which we used in part A. So if the money rate is lower and the inflation rate is higher, obviously the real rate will be uh, rate can become negative discount rate. So that's the answer. Okay, students, let me tell you about, yeah, money rate is adjusted for inflation. Money rate is adjusted for future inflation, and the money cash flows are also inflated cash flows, and real cash flows and real rate are not, right? Okay, so students, let's talk a bit about time management in the exam before I move on to question number 2. There are many tips for time management in the exam. Right now I'm discussing a few ones. Now look, what happened that a student appears in the exam, and in the end he's left behind with a few questions. Suppose he's not being able to uh, complete the exam and he leaves back 20 marks. He's only able to attempt 80-mark exam, and even after out of that 80 mark exam, he gets a few questions incorrect. He gets a few questions wrong. So he won't be getting 80 marks, he'll be getting even less marks, right? So what can be some of the reasons behind this? So students, remember that when you start the exam, give some time and go through the questions which appear in the exam, right? And when you go through the questions, first make a judgment that what questions are easier for you to attempt, right? Those questions which are easier for you to attempt, like in section C, you know that out of the two questions given in section C, one of them is a question which is very good for you and you have perfect or good knowledge of it, right? So do that question first. So when you make an order that what questions you know well, you will be first doing those questions which you know well and you can score good out of it. So what happens that if you know 60 mark of exam or 70 mark of exam very good, you will be doing it first and you will be doing it fast. Now if you attempt those questions which are not good, which you do not have a good knowledge of and you are not in practice of, and you put time in it, so you will be wasting some time and you won't be getting any marks. So what happens that in the end you miss 20 marks question which are well prepared by you in order to do those questions which are not well prepared by you. So you wasted some time and the exam finishes. So this is a big blunder. You have missed a lot of marks which you did knew. So if you fail due to this is not good. That even after knowing the topics, you didn't even attempted it and you failed to take marks. So it is always better to attempt first, make a judgment, go through the question paper first and attempt those questions which you are good at, so that you first make yourself safe. So now what happens that if you know 60 to 70 mark uh, well in the exam and you attempt that first, so in the first 2 hours you will easily attempt that, or in even if you take 15 more minutes to 2 hour 15 minutes, you will be doing that. And now after this, the 30 marks left are either doubtful or you don't know them. So even if you get some marks out of it in the last 30 minutes or 45 minutes time, that are additional to you, right? So at least you get those marks which you know well. And then even out of the areas which were doubtful for you or which you did not know, you make guesses, or you make a guess, or you can even take some more marks up in excess of the good marks you already knew. So this is one of the way how you can save yourself by attempting the portions which you know well. So one of the student asked how to pass FM in first attempt. So one of the answers is that if you do your basics well, you do a lot of practice first of all, like you do properly the past exam papers, you do the exam kits properly. Now by doing exam kit only once, it's not enough. At least you should do the questions 2 or 3 times, so that things you start remembering things out of it, right? So by doing this, if you remember things, you can do things a lot faster, and you can do predict newer questions in a better way. So yes, for the theoretical points, students, again it needs practice. The more questions you do from the objective test questions out of your exam kits, and the more the chapters you read, you do well. Let me give you a tip over here, that first go through the exam kits. Right now it's not the time that you read the book first. Do the exam kits first. Yeah, Kaplan, if you have time, uh, 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 there are many questions which are common in Kaplan and BPP kit, so you can do both, right? So at least do the objective type question and scenario type questions from both the kits, and then you can do some good questions which are covering the syllabus, being selected from BPP and Kaplan both. And instead of doing too many questions of this section C type, do it again and again so that you start learning them and remembering them. Yeah, obviously negative inflation is not possible in the real world. It is it can sometimes occur in depression times, which where the world has faced in the past, in the early 1900s. Okay. We'll talk a bit about in remote exams also. We can cover in remote exams also. It is not that difficult. You need to be smooth and calm. That's all. You have to use your brains and be calm in the remote exam. You can do. Okay. So students, don't worry. We will be doing some theoretical questions as well. Once we come on to the section C exams, uh, there will be parts in the section C exam questions as well, which are present in today's work also, in which we will be doing some theoretical questions as well. So we will be covering those as well. Okay. So students, uh, these handouts cover questions which are basically covering most of the syllabus areas in our exam. Not all, but at least 80% of the areas are being covered in this handouts, right? So I'll be guiding you about course coverage more in this workshop as we move ahead. So it's better that we keep doing some questions along with these discussions in our workshop, right? So that both the things carry on, our practice work and our tips area as well, right? Okay, students. So let's move on to the question number 2. It's care company. So please, students, go through this question, care company, and then I'll proceed further with the requirements of this question. So I'm giving you a 4-minute time, 4 to 5 minute time to read this question out. Then I'll start doing this. I'll be starting to do this question. Okay, students, let's start doing this question. Now, this question covers first asset replacement decision. Now, what are asset replacement decisions? Asset replacement decisions cover the time interval between which we shall replace our assets. Like in investment decision, if we have purchased a machine, the life of which is 10 years, right? Now, it is not necessary that if the economic life of an asset is 10 years, we also use it for 10 years till the asset gets scrapped. It is sometimes better to replace it earlier, like in 3 years time, or in 4 years time, or in 5 years time. So in that case, you can get a better resale value. After 4 years time, you will get a better one, and 5 years time, you will get a bit less than 4 years. Secondly, as the asset gets older, your maintenance cost increase. You have to put in some extra effort and cost in maintaining that asset as it gets older. So it is sometimes better to uh, replace the asset earlier. So how earlier should the asset be replaced? This is the question in the asset replacement decision. One of the students says that I have studied most of the portion from the CS syllabus. I'll just tell you, suggest you that student, one of the important thing is we in order to prepare an exam, we should be doing the practice work which is relevant to the particular qualification. Like if we are attempting ACCA exam, right? So just try and make an effort and go through the ACCA's exam kits, Kaplan and BPP, and go through the past papers which are available on the ACCA global website. Now, once you go through these practice material, you get a bit relevant and you know how to answer according to the relevant qualification. So you will easily pass it. Don't worry. Okay. So student, let's start with the replacement decisions now. So what is one of the methods being used to determine that in how much time we should replace the asset is equivalent annual cost method. So there are two steps in equivalent cost method, in calculating equivalent cost method. Step one is calculating the present value of cash flows that are associated with replacement. Now, the cash flows that are usually associated with replacement are the purchase cost of the asset. Second, the cash flow that is relevant is maintenance cost or the annual running cost. And the scrap value. These are the main items that are involved. And then first we'll calculate the present value of these items. Then in the second step, we will calculate the equivalent annual cost. So The formula for the equivalent annual cost is EAC is, this is equal to the present value which has been calculated in step 1 divided by the annuity fraction. This is the formula for the equivalent annual cost method. Equivalent annual cost method is an annuity. Annuity means that if the business involves a payment which is equal every year, what that payment would be. So equivalent cost is just like rent or an annuity, that if the business incurs a cost which is equal every year, what it will be. So if the cost is high, obviously you won't select it, you will be selecting the replacement time which will be incurring lesser cost. So in the first step we will be calculating present value, and then we will be calculating the annuity, and the option that results in the lowest equivalent cost will give you the lowest cost. So we will be selecting that option. So let's first do this question and calculate an EAC. So if we take the purchase cost, the present value of the purchase cost will be the same as the actual cash flow which will be incurred. So it is 540,000, right? Which is which I have taken in minus, which will be an outflow. This is about machine 2. We are talking about machine 2. Then the replacement time being given is 3 years. So, and the scrap value is 120,000, and the annual running cost is 47,000. So the next cash outflow is 47,000. We multiply it by the annuity fraction at the discount rate, which is 10% in this question. So at 3%, the annuity fraction is 2.487. So minus 47, this is the running cost, multiplied by 2.487. This gives you the present value of the maintenance cost. Now the maintenance cost will be incurred every year. The 47,000 amount will be incurred every year. So I have multiplied it 3 times with 1.1 to the power minus 1, that 1.1 to the power minus 2, and 1.1 to the power minus 3. You can, if you add all these 3 fractions, you arrive at the annuity fraction, which is 2.487. So you can use that formula 1 minus 1 plus r to the power minus n divided by r, the annuity fraction as well in this case. Okay. Yes, let me, Manish, let me complete this part, and then I'll explain you again. Okay, the resale value in this question is, first see the steps, and then I'll explain you again. The resale value is 120,000, and this will occur in 3 years time. So the present value in 3 years time, so it will be 120,000 into 1.1 to the power minus 3. So this makes some rounding of these numbers. So this gives you the present value of the cash flows. Now see, let me explain you the EAC concept, equivalent annual cost concept, that if I use this machine for 3 years, I'll be purchasing it for 540,000 first. Then for 3 years, I'll be incurring 47,000 its running cost. and then in the end I will sell it. So over at that time I will get an inflow of 90,000. That's why I've taken it positively. So what happens that in 3 years time, what present value have I incurred? So in 3 years time, the present value that I have incurred is minus 567 approximately. But this is the cost over 3 years time, right? Now there is a question. If I'm comparing a proposal with 4 years, can I compare 4 years NPV with 3 years NPV? I won't be able to compare because the timings do not match. But if I calculate cost for 1 year, and that's equal cost for every year, and annuity is equal payments, right? So if I convert this 567 into annuity, right, what happens? I get an equal cost for the 3 years time, and I will compare the EAC of 4 years with this one. So this cost will also be for 1 year's time, and that 4 years time interval cost will also be calculated in EAC terms for 1 year. So these will become uh, relatively comparable because the timings will be 1 year cost with 1 year cost in case of 3 years replacement and in case of 4 years replacement. So this is how it works. So I calculate annual cost in both the cases so that it gets comparable. So in the case where my cost is the lowest, I select that one. So in the next step, what I calculate is the annuity. So EAC is basically the annuity. So the present value in step 1 is minus 567, and I will divide this 567 by the 3 years annuity fraction because the cost is for 3 years. So I will divide this by it by I will divide it by the 3 years annuity fraction, which is 2.487. So dividing this gives me the EAC. Okay, let me show you the working as well. Minus 567 divided by 2.487. This gives you the EAC, which is 228. So now this EAC is the annuity. It is the equal payment that will occur over 3 years, means 228 per year for 3 years. This is obviously adjusted for the cost of capital as well. This covers the time value of money as well. Okay, Manish, have you understood this EAC? So okay, 2.487 is the annuity fraction. It is 2.487 is the, you can use this fraction 1 plus 1 minus R divided by R. This gives you 1 plus 1 minus R. This is known as annuity fraction. So instead of multiplying an equal amount for 3 times with 1.1 to the power -1, -2, and -3, we use this fraction to solve it. And in place of r, put 0.1. So we'll get 2.487. So 2.487 comes from this fraction. So you can see this fraction from the annuity table as well. Resale calculation is 120,000 is the resale value given in the question into, it's not 1.01, it is 1.1. It's 10% fraction, so it's 1.1 to the power -3. Simple. Okay. Okay, students, moving on to the part B. Let's do part B now. So according to the question, the part B asks for drag and drop the relevant statements to indicate whether they are true or false. The equivalent annual cost calculation assumes the same type of machine is going to be used into the foreseeable future. That's very correct. That's correct that the machine type should be same. We just need to decide in this replacement decision that what will be the time interval for replacement of the assets. What we just need to know the time interval between the replacements. So the conditions that prevail regarding the type of machine we purchase and the circumstances that exist, that those should be same. Only the time intervals shall be different, because we need to decide between that in how much time we have to replace the asset. The machine should be same, they should be identical. That's very correct. If the machines are different, obviously their capabilities will be different. So the NPVs will include the effect of the capabilities of machines as well, which we don't want to know, that what type of machine we need. We just need to know that the same machine or same type of machine, if we need to replace in 2, 3, or 4 years time, so what time interval will cost you the least? We need to know that. So the machine should be identical. Okay, second, the equivalent annual cost calculation assumes the capabilities of machine 1 and machine 2 are identical. So the second one, what do you tell? The second part is also correct. So both of the statements 1 and 2 are correct. Okay, students, let's move on to the part C. This is a good question. Please read this requirement. I am giving you around 2 to 3 minutes to read this out, and then I will solve it. So this relates to risk and uncertainty portion of this investment decision section. Okay. Okay, students, the formula I have written for annuity fraction in speed, I have placed the signs incorrectly over there. So let me make the correction. So it is 1 minus 1 plus r. 1 minus 1 plus r to the power minus n divided by r. So please make the correction. Sorry for this clerical problem. Actually, sometimes we are doing things in speed. So sometimes some typographical errors occur. Yes, Kantesh, I'll be explaining the presentation also of the section C type when when we come to question 5. We'll be doing the presentation aspect as well. Yes, Salman, I'll try to give you some formula sheet as well. Section A and B presentation will not matter. Students, remember one thing, that in case of section A and B, your workings will not be considered. Your final answer will be important. But in case of section C, your workings will be read by the examiner, and obviously your working will carry marks. And if you make proper workings, but you're suppose you make a clerical mistake in either calculating or punching in figures, still you will be awarded marks. But in case of section A and B, no marks will be awarded for your workings. So don't worry about the presentation of workings in section A and B. Only C you have to worry about it, right? Okay. So students, what the question says, that the business do not know about that whether a competitor will enter the market or not in the future, and the business do not also know about the strength of the dollar against the currencies, and due to this the final scrap value may fall due to both of these. So what happens, that let me tell you what the question says, that each of these, the entry of a competitor and the strength of the dollar against other currencies, will reduce the scrap value by 10%. Each of these means if both of them are present, the competitor also enter the market and the strength of the dollar also decrease. So the decline will be 20% in the scrap value, and the scrap value is assessed to be 120,000. So let's make a working on it. See, there are 4 possibilities in this case. Let me tell you about the 4 possibilities which are present in this case. The first possibility is that the new supplier enter the market. Yes, suppose the first possibility. And then the what is the probability that a new supplier enters the market? So they have given that if the new supplier enters the market, the probability will be 40% of it. Then 0.4 is the probability. of the new supplier entering the market. Secondly, the next point is along with increase in strength of US dollars against other currencies. So suppose that the dollar also strengthens, or the strength of the dollar change. So what happens? What are the chances of this, that the strength of the dollar will change? They've also given you the strength. So the strength of the dollar change, the probability of this is 0.3, which is 30%. The probability is 30%. So one of the probability is that both of the things change. The new supplier also enter the market, and the dollar value also changed. So what happens that in this case, 120,000 multiplied by 80% will be the resale value. A 10% decline due to both. So this makes 120,000 multiplied by 0.8. This gives you 96,000, right? Now, the second case, this was the first possibility. The second possibility is that yes, the supplier, a new supplier enters the market, but the strength of the dollar do not change. So what's the proper probability that the strength of dollar will not change? This is 0.7, 70%. So in this case, the scrap value is going to be 120%, and as there is only one change, there will be a 10% drop. So 120,000 multiplied by 90%. This gives you 108,000. The third case, no new supplier enters the market, the probability of which is 60%. But yes, the strength of dollar changes, the probability of which is 0.3. So in this case also, only there will be a 10% decline from 120,000. So it's 108,000 the scrap value will be. And the fourth and the last case will be no new supplier enters the market, and neither there is a change in the strength of the dollars. So the probabilities will be 60% and 70%. In this case, the resale value remains at 120,000 because none of the variables affect the resale value. Okay, so these four will be the resale values that can be expected in future. So the possible resale values or outcomes are as follows. Now in this case, you have to use the joint probabilities. This is a question of joint probabilities. Now what is the joint probability? In order to calculate the joint probability, you know that the chances of a new supplier entering the market is 40%, and together with this, the chances that the strength of US dollar will change is 30%. So what's the combined probability? The combined probability is 12%. 30% of 40% is the probability. 30% of 40%, which makes 12%. So the joint probability is multiply both of these, 0.4 into 0.3. This gives you the joint probability 12%. Likewise, in the second case, multiply 0.4 with 0.7. This gives you 28%. And then 0.6 multiplied by 0.3 gives you 18%. And the fourth case, 0.6 into 0.7. This gives you 42%. So the combined effect of all four items should be 1. All the probability should sum up to 1, right? Now we will multiply the possible outcome with the joint probability in order to arrive at the expected value, because they are asking for the expected resale value. So multiply this joint probability 0.12 with the possible resale value. So if you keep multiplying 0.28 in the second case multiplied by 108,000, likewise 0.18 multiplied by the 108,000 and 0.42 multiplied by 120,000. This is known as expected value. This gives you 111,600. This is the expected value they are asking for. So there can be various resale values in future, right? It can be 96,000, it can be 108,000, it can be 120,000. But expected value is an average of all of these. So if this 120,000, 96,000, 108,000 keeps recurring again and again and again according to the probabilities which are given, so in years to come, in several years to come in the future, if you take an average, it will be 111,600. So expected value is a weighted average. So the correct answer to this is 111,600. So first, make the working for the various possibilities, right? And then calculate the joint probability, and then multiply the joint probability with the possible resale outcomes to arrive at the expected value, which is sum of all the outcome multiplied by joint probabilities. So this is how we get the. So I'm waiting for you to complete this answer. Okay, there is a question by Mutayyaba that how did I get 96,000? I have shown the working beside the numbers. See, okay, let me explain you what they say. They say that the resale value is 120,000, right, which was given in the first part, right? And they say that if a new supplier enter the market, there will be a drop in the resale value by 10%, right? So if there is a new supplier entering the market, then 10% drop, right? And if the dollar strength change, yes, so both are present. So 10% change and decline in resale value due to this change in strength of dollar. So combined, what will the combined effect? It is 80%. So multiplying this, you get 96,000, right? Now in second case, there is a supplier entering the market, but no increase in strength, a change in strength of dollar. So only one variable is changing. That's why I'm taking 10% change. Over here also only one variable is changing. This one, the strength of dollar is changing, and no new supplier is entering. But in the last case, no changes. Neither a supplier enters the market or the dollar strength also do not change. So I have taken the full amount, which is 120,000. This is how I have taken the numbers. Okay, I'm waiting for you to copy it out. one of the students have asked that why have we taken machine 2 in this case. So please look at the requirement over here. They have asked about machine 2 only, right? Okay, so the correct answer is C. Okay, I'm waiting for people to copy and complete it. Students, let me complete this question. Once I complete this question, I will be giving you a break. For prayers, and if you want to refresh yourself. No, the sum of all the outcomes into probability is the expected value. So first we have to multiply all the resale values with the joint probability, and when you add all the 4 items, then you get the expected value. The expected value is only one item. Shahid, this is for you. Okay, are you people being able to see my screen? Okay, thank you for responding, students. Okay, let's move on to the next question, students. Part D and E, and then we will have a small short break, and the 10-minute break, and then we'll continue again. So part D. To overcome the difficulties of probabilities into the investment appraisal question calculations, CAD company could perform a simulation exercise to help reach a decision. As I explained, simulation technique can calculate the effect of many changes, right? Like on NPV, on profits, on other areas. So simulation technique is itself nothing. It won't give you an answer that whether to invest or not. It will give you a calculation of either NPV or either profits by studying the effects of various changes in sale prices, variable costs, fixed costs, these type of things, right? Okay. Secondly, let's see the options first. What do they say? Okay, which options are true or false? What about one? It eliminates the effects of risk associated with various estimates. So risk cannot be eliminated. If a loss is going to occur in future, you cannot eliminate the that loss, the risk of that loss in future. The risk is there. You just calculate and have an effect of that risk of loss on your NPV. Your NPV will reduce. That's all. The simulation will cover that loss element as well in your calculation. but it won't reduce your loss. So 1 is not at all correct. Okay, then next, it requires probability of estimate subject to risk to be known. Yes, without using probability, you cannot calculate the expected NPV. Simulation can give you an expected NPV. So simulation will be a working that will give you expected NPV when various variables change. So the second part is correct. Yes, probabilities will be involved in calculating the expected NPV in the simulation technique. So the second one is correct. Only the second statement is correct. Part E. Okay, let me tell you one thing before going on to part E, that when you are calculating and you are determining that in how much time the asset should be replaced, there are three methods which are used. One is finite horizon method, which is not a very good one, so it's not usually used. But the two best methods are the LCM rule, the least common multiple rule, and the equivalent annual cost method. The least common method rule, LCM, and the EAC rule. EAC rule we have studied, and the LCM rule involves calculating NPV for the LCM of the years, least common multiple of the years. For example, if you have a 3-year replacement time to be compared with a 4 years replacement time. So what will be the LCM of 3 and 4? It will be 12. So we will calculate present value of 12 years in case of 3 years replacement and in case of 4 years replacement. So the time span for 3 years replacement and 4 years replacement, right? For both, it will be 12 years. So I will be calculating present value for 12 years. If I calculate present value for 12 years, 4 times the replacement will occur. And if I calculate for 12 years, then 3 times the replacement will occur. So then I will check that in which case, 3 years replacement time or 4 years replacement time, I will be bearing a lower cost. This is how it occurs. Now they don't ask you LCM rule. The most popular method is EAC rule. That's why they are asking EAC rule in the syllabus. But over here, theoretically, they are asking it. Which of the following statements about CAD companies replacement decisions are true? The first one is the decision between machine 1 and machine 2 could be found by calculating total NPV of each machine over 12 years. So this is up, they are talking about the LCM rule. So earlier when we were discussing the two options in this question, one of the options was in the machine 1 case to replace in 4 years, and the machine 2 case that we calculated was replacing in 3 years time. So 3 multiplied by 4 made 12 years. So this is what they are talking about, the LCM rule, that what if we calculate, we do not in that case we don't calculate EAC, we just calculate present value, the step 1 only, and the option with the lowest step 1 value, present value, will be considered, and that will be the most feasible option. So 3 into 4. So if we have option to select in 3 years and 4 years time, so the total NPV can be calculated for 12 years time. This is what they are asking about, LCM rule. And then the replacement analysis model assumes that CAD company replaces like each time it needs to replace an existing asset. So again, this is also correct. The machine should be identical, both of the machines, in case of the replacement analysis model. So both of these are correct. Both the statements are correct. The correct answer is B. Okay, students, before moving on to the question number 3, let's take a 10-minute break. I'll be joining, we'll be continuing back in 10 minutes time. Okay, students, see you in 10 minutes time. Please be there in 10 minutes time. We'll be doing capital rationing question in 10 minutes time. See you. So I'm muting the muting my voice, and after 10 minutes I'll be unmuting it again and we'll start. So take a break, 10 minutes. Welcome back, students. I will resume again now. So students, our next question is question number 3, Easter Company. This is based on capital rationing. Let me explain a bit about capital rationing before we go ahead. Now what happens that in investment decisions, the business may be having a lack of capital. It may be having a shortage of funds. It may not be having enough cash that it can invest in all projects that have a positive NPV. So suppose that there is a business which has 10 projects with positive NPVs, and those projects require $25 million, but the company has only $20 million. Now this is a rationing situation. Rationing situation means that the company will have to select a few projects out of those 10, and obviously it cannot invest more than 20 million. So within 20 million, the funds which are available with them, they have to maximize their wealth. So they cannot invest in all. So in the situation where the company cannot invest in all projects, this is known as a capital rationing situation, right? So now there are two types of rationing situation. One is known as soft and one is known as hard rationing. Hard rationing means that the creditors or the investors in form of shares, the equity investors, they are not uh, allowing funds to the company, and they are not investing further funds in the company, which if the company would have raised from outside, they could have made further investments and could have earned further NPVs. So this is known as an external shortage, external rationing, or a hard rationing. So hard rationing means that the company is not being able to generate funds from outside sources. And soft rationing means that the managers and the directors and the owners within the company, they do not intend to raise further funds from people outside the company. Means the shortage is internally generated. The shortage of funds is placed internally. Like the company has made capital expenditure budget and they do not want to exceed it, and the management is feared that if they start new projects, they may take more risk and they may not be able to handle it. So they have placed a limitation themselves on raising further funds. So if the management or the director or the shareholders, they place restrictions on the funds themselves within the entity, this is known as soft rationing. And if people outside the entity are not providing funds, then this is known as a hard capital rationing. So the first question in this question number 3, the first requirement in question number 3 is related to hard and soft rationing, the types of capital rationing. First, students, you need to go through the question number 3. Please read out the question 3. I'm giving you around 3 to 5 minutes time to read it out, and then I'll proceed ahead. Okay, students, let's have an activity. Requirement A has 4 statements. First, second, third, and fourth. Which one do you think is the correct one? You can answer on the chat. Which one of the 4 do you think is the correct one? So students, over here in this question, the correct answer is the third one is truth. Hard rationing is the result of external factors and soft rationing is the result of internal policies. The first one is not correct because both hard and soft rationing are not as a result of external factors. Only hard is, and then both second one is both hard and soft are result of internal policies. No, they both of them are not. And then soft rationing is a result of external factors and hard rationing is the result of internal policies. This is oppositely given. This is also not correct. So third one is the correct one. So one of the reasons, student, a tip that one of the reasons for the question's answer gets incorrect is that we do not read it properly. We do not read it properly, that what they are asking. Either we do not read the question properly, or the other reason could be that we are not reading the answers properly, which are the statements which are given in this uh, true false section. And secondly, remember that if we have to select more than one or two or false, and we do not get all of them correct in an objective type question, we won't get any mark. In order to get full mark, you have to get all of them right. So that's very important that you get all of the true false, all of the 4 statements correct. If you get even one of them wrong, you won't get any marks. So you should be very, very serious, and you should be very, very uh, careful when solving these type of questions. So do not hurry. Give a bit of time and do not be scared. Be cool when reading the questions and go to the exam very fresh. Take proper sleep when you go to exam, because if you are not very fresh in the exam, you may not read the questions properly. And if you do not read the question properly, obviously the chances of the questions answer getting wrong gets very high. So the third statement is correct. Okay, now moving on to the next part of this capital rationing question. Requirement B. From the list below, select which 2 projects should be accepted based on the circumstances described. So which two projects should be accepted based on the circumstances described? Let me explain you first a few things regarding this question. In this question, if you see the investment amounts, the investment amount is a lot more than the funds available for these projects. The Easter company has just 10 million, and the investment amount is more than 10 million. So you cannot invest in all these projects A, B, C, D, and E. So you have to select some out of it. Now, which projects you will select? So for this purpose, in order to select projects, uh, first check one thing. None of these projects are divisible. Any of these projects are not divisible. Divisible means you cannot purchase a piece of it. You cannot purchase a 20% or 50% or 70% of it out of it. You have to either purchase the whole or you leave it. So the projects are indivisible. You have to purchase the whole or leave it. You cannot purchase portions out of it or a few percentages of the total investment. So first of all, what we will do that in order to make it easier, first of all, we will divide the NPV earned from the project by the investment amount. If you divide the NPV by investment amount, you come to know that which projects give you the NPV per dollar. By investing $1, how much NPV you earn from a project? The project that gives you the highest NPV per dollar of your investment will be the best one, right? So you can make an order like when you were doing uh, the questions with labor shortages. So what you did over there, you calculated contribution per hour over there, and you selected the proposals with highest contribution per hour, right? And rank them as first. Over here the funds are short, so what you should do, you should calculate the NPV on the basis of which we select the projects, and we should divide NPV by the dollars which are short over here. So the procedure over here is same, NPV per limiting factor. So first of all, we will calculate the NPVs per limiting factor, and then we will move ahead on calculating this requirement. So I'm starting to calculate the NPV per dollar. Acha, this NPV divided by investment, this is known as profitability index. So students, the NPV from project A is 4900, from project B was 7400, from project C was 5900, from project D was 7500, and from project E was 9500. Now dividing these by investments, 3200, 9320, 7300, 5200, and then 5600. This gives you the NPV per dollar invested in a project. So this is the profitability index. Now, if we rank these projects, so the order will be, first the investment should be undertaken in project E. This is the best one. This is giving you 1.7 NPV per your dollar of investment. Then the next will be project A, then third will be project D, then fourth will be project C, and the fifth will be the project B. So this will be the ranking. So according to the question, the requirement B, from the list below, which two projects should be accepted based on the circumstances described. So which two projects should be selected? So obviously the first one will be E, and then the second one will be A. So these two projects needs to be can be selected, but keep in mind that the total amount to be invested should not exceed the 10 million amount, because you have a limited amount of funds available. So in project E we need 5600, and in project A we need 3200 of investments, and the total of these two makes 8800. So if we invest in the first two ones, we can generate the highest NPV. Any other combination will not generate this much of NPV. If we add project B to E, that's not possible, because it would require more than 10 million. You can't even add C to E. You can't even add D to E, because they need more than 10 million investment requirement. Okay. So students, moving on to the next one. The answer, let me write the answer first. So we'll select project A and project E. These two will be selected. Now moving on to the part C. What projects would be accepted if it were found that project A and E were mutually exclusive? So what do they mean to say that the projects are mutually exclusive? The projects, by mutually exclusive, we mean that you can select only one out of A and E. You can't do both of the projects. You can't do A and E together. This is what they mean to say, that both of the projects together are not viable. You will have to select only one out of A and E. So if you select one out of A and E, then you can invest in any other project as well. And the second project can be the project D, the project with rank 3. You can select the project with rank 3 together with A, but you cannot select project 3 with project E, because the total amount of investment required will exceed 10 million. So now in this case, I cannot start with project E, as after investing in E, I won't be investing in A, because they are mutually exclusive, right? So then I'll have to go to D. So after E, if I go to D, I will be needing more than 10 million, which I do not have. So E and D are not possible. So obviously I will have to start with the second rank project, which is A, which needs 3200, and then I will invest second in project D, which is ranked 3. So after first investing in A, I will be going for project D. So that's practically possible because the both items in green will need together 8,400. Now you can check that any other option then this is also not practically possible, so no need to check because all other options required more than 10 million. So if A and D are if A and E are mutually exclusive, then we can select projects A and D. So the correct answer is A. Okay. Now moving on to the next part. So students, in the next part, which is requirement D, what projects and fractions of projects would be accepted if a partner could be found to invest in a proportion of one of the projects, making them effectively infinitely divisible. Infinitely divisible means that now if you cannot invest in the whole of a project, so you can make someone else a partner who will invest in the remaining of the part. Like suppose you invest in 23.5% in a project, so the remaining 66.5% will be invested by someone else. So the project becomes divisible. Divisible means that you can purchase a piece out of a project. So what happens in that case, that you can follow the ranking, and they say that ignoring that project A and E are mutually exclusive. So in this case, project A and E are not mutually exclusive. So what happens that if the projects are infinitely divisible, then you can use all of your funds. In the previous examples, what happened that out of your 10 million amount, you were either able to invest 8,800 or 8,400 out of your total 10,000. So the remaining 1,200 or 1,600 remained uninvested. But in this case, as you can find a partner, so you can invest all of your 10 million, because if anything remains uninvested, another partner will join you and he will make the remaining investment. So all of the funds of yours can be invested, which remains uninvested in the requirement A and B, and which remained uninvested in requirement B and C. So in D, all of your funds can be invested. So look how can this be answered in part D. You will start with project E, which was ranked as 1. Starting with E, its rank was 1. The funds that are available are 10 million. I've taken dollars in thousands. So first of all, in project E, the investment amount required was 5,600. Then we will invest in project A. After E, the secondly ranked project was A, and it needed 3,200 of funds. So 3,200 invested in the project A. Now you are left with how much? 1,200. And then the next ranked project is D. The rank of project D was 3 with respect to the earnings. Now, in case of project D, the total investment amount was 5,200. So you cannot invest all of it, but you know that you have a partner, so you will invest 1,200 out of it, and all of your funds are utilized. Now you don't remain with any surplus. So that's the advantage of a divisible project, that you can purchase a part of it, you can purchase a piece of it. So now in this case, we need to know that what percentage out of a project you should select. So out of project E, you will select 100% because it was ranked 1. So obviously you will buy the whole of it. It's earning the best for you. Then second best was the project A. So you invested 100% out of it. And in this case, in project D, divide 1,200 by 5,200. So you can invest just 1,200 out of 5,200 and multiply it by 100 to arrive at the percentage you can invest in it. So 23% approximately, or 23.08% you can invest in project D. So over here, in this case, the correct answer is, if you divide 3 by 13, it gets 23%. 3 divided by 13 is 23%. So the correct answer is B. According to B, investment will be undertaken in A fully, then E, and then 3 divided by 13 in D. This is the answer to this question in case of divisible projects. Okay, so students, you can make a note of this answer, and I'll move ahead in a 2 minutes time. Okay, moving on to part E. Okay, for part E, they say that which two of the following statements represent likely causes of confusion over project F. So in this case, students, you need to note that usually what happens that we have projects in which there is an outflow in the beginning. That is, we make an investment in the beginning and we pay money. And then what happens that after we make an investment and pay money, the cash starts coming back to the business. So all the cash flow after making the investment at the beginning is positive. Like if there is a 5-year project, the year 1, year 2, year 3, year 4, year 5 cash flows are positive. So this is known as a conventional cash flow, right? Over here, if you note that on time 0, there is a negative cash flow of minus 4 million. And then again, in year 2, there is a negative cash flow, 4.83 million. So this is an unconventional cash flow, not normal as we do. So in this case, unconventional cash flows, there can be 2 IRRs. Right? There can be 2 IRRs in case of unconventional cash flows. There can be more than 1 IRR, you can say. Right? So more than 1 IRR means at least 2 IRRs, right? So this one gets correct. It may have more than 1 IRR. Secondly, so what we have to do, read the question carefully. Which 2 of the following statement represents likely causes of confusion over project F? Right? So one of them is that it has 2 IRRs, so it is difficult to select which project to select. At what IRR shall be considered? Like for example, one of the IRR is 5%, at which NPV is positive, and the second, what is IRR? Do you remember? Do you remember what is IRR? The rate at which NPV is 0. So your cost of capital should be lower than IRR. Means if the IRR is 5%, your cost of capital should be lower than 5%. Now suppose there is an IRR 5% and the another one is 10%. So 2 IRRs are there. So 2 IRRs means there are 2 rates at which NPV is 0. So cost of capital should be, for example, 5%. It should be, what should be the cost of capital in this case? It's difficult to select, less than 10% or less than 5%. For example, there are 2 rates, 15% and 5%. What cost of capital will be acceptable in this case? So what is the rule for IRR? That you should select a project with a cost of capital which is lower than the internal rate of return. So it will create a confusion that whether to invest or not if there are 2 IRRs. Second case is this. A, it has a negative NPV when undiscounted. So over here, if you see, if you do not discount this, means you do not calculate any present values, even then there is a negative amount. See, deduct 4 million and 4.83 million from 8.8, you will get a 0.03 negative amount. But this is not NPV, remember, this is just a loss. Present value has not been considered. But if you calculate present values of these, for example, at 10%, you will get a positive NPV. For example, if you get a positive NPV after calculating present value, you can invest in it. So it is possible that you deduct receipts and you deduct payments out of the receipts without calculating present value. You get a negative figure. But once you calculate present values, you get a positive amount of NPV. That's always possible. So this is creating a confusion that ordinary cash flows, receipts and payments is giving you a negative amount, but a particular rate is used to calculate the present value at that time. The NPV is positive. So this is creating a confusion. Otherwise, these three are not confusing because it do have an IRR, and one positive and one negative IRR is not like that. There are two IRRs, positive IRRs. So that's one is also not confusing. And then it never earns a positive NPV, so there's no confusion. It do earns positive NPV. So the correct answer over here is, this was a difficult one. So A and E is correct. These two are creating confusion as to deciding that whether to invest in the project at what rate and whether to either invest in it or not. So A and E is the correct answer over here. These two are creating confusion as to the decision based on internal rate of return. Okay. So students, that's question number 3. Let's move on to the question number 4 now. Okay, students, let me give you some assignments as well for the next class, so that you yourself also keep on doing practice. I'm not giving you anything new. I'm giving you only those things which I have covered in this workshop and this webinar. So the next question is also on capital rationing, which I want you to do, and I'll share the answer with you in the next class, in the next, which means tomorrow, with you people. So let's have an assignment as well. So question number 4 is being given to you people as an assignment. We will share the answer tomorrow. And then we move on to question number 5, because question 4 is also on capital rationing, and this was examined in the last attempt, probably in the last 2 attempts. One of the last 2 attempts this was examined. So it's an easy question, not a difficult one. You can manage it easily, but you will get an idea of the exam question if you solve yourself. So the next question is, Crockett Company. So this Crockett Company is your assignment for your next class. That is on Tuesday. Okay, now I'm moving on. Okay, you will be you are having a Word document in your control panel, so you can obtain this question, all of these questions from that handout. Crockett Company, right? Okay, now we'll be doing question number 5. This is SC Company. So students, this is now we are moving on to the section C question. So we are doing now section C type question. This will be available probably after the these sessions will be available on YouTube. I think after the completion of the workshop, either all or some of them. Once they get ready, because it takes some time to compile, so they will be made available to you people. Okay. And in a day or two, I'll be sharing these Excel sheets as well to you people for you to get the working. But you people keep noting it and doing some calculations on calculator so that the learning gets faster. Okay, so students, let's move on to the next question, question number 5, the SC company. So this is a question on NPV, net present value, and IRR. So let's begin with it. You can read it first, and then I'll start doing it. So we may we may be left with some questions by the end of today's workshop, which will complete tomorrow as well. So tomorrow we'll be doing investment appraisal and a bit of investment appraisal and working capital management as well. So students, please read this question. I'm giving you around 4 minutes to read it, and then I will start doing it. Now this question involves inflation, taxes, capital allowances, and working capital as well. Changes in working capital during the project. By the time students you are reading, I'm making the pro forma to solve this question. First of all, students, you need to check that what is the life of the project. Life of the project means that for how many years the cash flow will occur. So in this case, the cash flow will occur for 4 years. consider tax as well. When do the tax payments occur? So according to the question, the tax payment occur in the same year in which the profit arise. So if the project is in the 4th year, so in the same year you will be paying the tax. So you won't need to go for 5th year. But sometimes what happens, that the question says that the tax payments will occur 1 year after the profits are earned. So in that case, even if the project is for 4 years, you have to make the cash flows for 5 years, because the tax will be paid in the 5th year for the profits earned in the 4th year. But it's not in this case. In this case, the question says that the year of payment of tax is same as the year in which the profit has been earned. Okay, so let's make pro forma for 4 years, which is the life of the project. Okay, now the presentation. One of the student was asking for the presentation for section C. So section C presentation is very important. You must show your workings. And one more thing I want to tell you, that in order to show workings, the examiner is bound to check all of your cells. Like suppose, if you can see the cell in which right now I'm working, I've shaded it in yellow. So all the amounts or the numbers, etc., which I am writing in this cell, these will be appearing over here to the examiner. So he's bound to check each and every cell. So all cells in the worksheet which you are being giving over there, the examiner is bound to check each and every cell. So if you do working in a cell, he will be checking it over there. So it's not necessary that you make separate workings somewhere else. You do your working over there only in those cells, right? So you will be saving some time. Like for example, in the year 1, regarding sales revenue. So what the question says, that the sales price of product P, the selling price of product P is $20 as per question, right? This is the selling price. And in the current price terms means these prices are at decision making date, right? So in an investment appraisal question where the inflation rates are different, like inflation rate for the selling price is 4% and for the variable cost is 3%. You have to use the money cash flows, yani you have to inflate the cash flows, and the rates shall also be a money rate. Like in the question they have given the rate, the nominal rate, the money rate is the same thing. Real rate is separate, is different. It is not including the effect of inflation. So this 12% is basically the money rate. So you have been giving a money rate, and as the rates are different of various items in the question, you have to inflate the cash flows. You have to adjust the cash flows for inflation. Means you have to increase the cash flows due, as that is an inflation, the prices in future will increase. So how will I do the working over here for inflation, that I'll show you. So see, the price they have given is 20, means on the decision making date. What I'll do, I'll multiply this by 1.04 as the selling prices are increasing by 4%. So this gives me the selling price at the end of year 1, and then I'll multiply this by the quantity, which is 35,000. Okay, so 20, you can see it over here also on the formula bar. Just check on the formula bar in black, 20 into 1.04 into 35,000. So this is the view which the examiner will have of your working. So that's enough for you. So again, I'm doing this working. So it is 20 multiplied by 1.04 multiplied by 35,000, 7,28,000. Now the next is 20 multiplied by 1.04 multiplied by 1.04. There will be two inflations in the year 1 and then year 2 multiplied by 53,000. In the year 3, 20 multiplied by 1.04 into 1.04 into 1.04, 3 times the inflation and then the quantity, which is 75,000. This gives you the sales. And then in the year 4, 20 into 1.04 to the power 4. This gives you the sales price, and then multiplied by 36,000 is the quantity. So this is how you can work. So this gives you 8,42,298. Now the variable cost in the same way you will do the variable cost. For variable cost, the selling price, the purchase price was 12 in current terms, multiplied by 1.03 multiplied by the quantity, which is 35,000, gives you 432,600. Okay, the inflation rate is 5%. So 12 multiplied by 1.05 multiplied by 35,000, and this is an outflow, so we'll take it in a negative. Then next year, 12 multiplied by 1.05 to the power 2 multiplied by the quantity, which is 53,000. In the third year, 12 multiplied by 1.05 to the power 3 multiplied by the quantity, which is 75,000. And then in the year 4, 12 multiplied by, you will increase the variable cost every year by 5%. So in 4 years, 1.05 to the power 4. And then the quantity, which is 36,000. So this gives you okay. Now this gives you the contribution. Okay, now let's calculate the contribution. So deducting the variable cost from the receipts, we get the contribution. Okay, and according to the question, they do not need to increase any capacities, so their fixed cost remains same. So fixed cost is not relevant over here. Fixed cost will be relevant only when the fixed cost increase. So only the additional portion, the difference between the new fixed cost and the old fixed cost will only be taken over here. The incremental portion will be taken here. Now about tax. Now on 287,000 there is a 30% tax. So you will the company will have to pay a 30% tax on it. So we will deduct 30% tax. So there is an outflow. There's going to be an outflow of 30% tax out of 287,000 in the same year. So you'll be taking an outflow of 30% for each year. This will be a negative as it will result in a cash outflow. So you people also keep calculating on your calculators. I'll be a bit fast over here as at places the calculations are easy to understand, so I get a bit faster. Achha, second point over here was that when calculating tax, I did not minus any depreciations or capital allowances over here. But for tax purposes, the tax departments will allow for depreciations and capital allowances. So in this question, there is a capital allowance available to the taxpayer, and that capital allowance is on straight line basis over the 4 years time. So the cost of the machine in this question I'm highlighting it in blue. The cost of machine was 1 million. If the cost of machine is 1 million and the capital allowance can be claimed on a straight line basis over the 4 years time. So if you divide 1 million by 4 years, as there is no residual value in this question, so if you divide it by 4 million, the capital allowance will be 250,000. So on 250,000, if deducted from the taxable income, the business will be able to save a 30% tax on it. So I am making a working of it in a cell. So please note down that working in the cell, tax benefit, which will be positive. It will be an inflow. It will reduce your tax, because if you get a tax depreciation, your taxable income reduce and you save some taxes. So obviously you are saving some money. So I have directly deducted 30% of 287,000, which is not 287,000 is not your taxable income. So I have deducted more. So after that, I am adjusting for the capital allowance, which will be gained in case of that the capital allowances can be deducted from 287,000. So if capital allowances can be deducted from 287,000, your taxes will be low. So how much will they be lower? That I'm showing you in the cell right now. So please note this, that equal to, let me show you, equals to 250,000 will be the capital allowance per year, and on this you will be saving how much? 30% tax. So you can show further also over here of working can be like this, that 1 million divided by 4 and then multiplied by 0.3. This gives you a 75,000 saving. So in all the years, as it's straight line method, there will be a saving of 75,000 in all of the 4 years saving in tax. So this is tax benefit on capital allowances. Then the capital expenditure amount is 1 million. And what about working capital? So let me show you a working for working capital. This was an important working over here. working capital requirement. Students, I will end at NPV working. So you may have to wait for a more 5-minute time, and then we will end. Okay. So let me do the working capital working. Now what happens that what the question says about working capital, let me show you. So this is an important working over here. I'll take a 5-minute longer time, students. Okay. So what the question says that investment in working capital for product P will need to be 7% of sales revenue for that year. And this, they are talking about working capital within SC company indicates that at the start of each year, means at the start of the year one, they should have a working capital need and requirement of 7%. So at the beginning, you have to invest this much of cash. You have to give the working capital cash to the business. So at year 0, you should have a 7%. Now look in the cell, what I have done. I've taken 7,28,000. The first year sales, and multiplied it with 0.07, the 7%. This makes 50,960, the working capital requirement at the beginning of year 0, 7% of the first year sales shall be invested in working capital at the beginning of year 1. Then what happens? By the end of year 1 or the beginning of year 2 is the same thing. At this time, the sales is 1146,496. Take 7% of this. So the working capital requirement becomes 1146,496 into 7%. So see, it is creeping up. The working capital requirement is rising to 80,255. Then the second year, you have to take the second year sales. Sorry, the third year sales. Second year means the end of second year. So the end of second year, you need more working capital requirement, which is 1687296 into 7%. And then by the end of third year or beginning of fourth year, you will take sales of the fourth year, which is 842,298 into 7%. So 58,961 will be the requirement. And then at the end of fourth year, the project will be over, which means the 48 months time. So at this time, the working capital requirement will become 0 because all of the cash, all of the products would have been sold, all of the receivables would have been converted into cash. So all of the money will come back to the business. Okay. So as at the end of year 4, all of the funds of working capital invested in the project come back, there will be an inflow to the organization. First, we'll be giving some funds to the organization and then we'll be receiving back. So how much funds we will be given to the project? See, at year 0, you will be giving 50,960 to the project. So we will take a negative amount over there in the pro forma in our working. So at year 0, we will be showing an outflow of 50,960. So at year 0, we invest 50,960, we give some cash. So in addition to 1 million cash by which we purchase the machinery, we will give a further cash 50,960 to purchase the raw material and payment, make payment to the labor and overheads things. And then look, next, this is very important. By the end of year 1, the working capital requirement gets 80,255, means the working capital requirement increase. So what we will do, we will deduct 80,255 from 50,960. So this gives you 29,295. The working is like this: 80,255 minus 50,960. This gives you 29,295. So you have to give some further cash to the business. 50,960 was already there. Now you will have to give 29,295 to make the working capital requirement at 80,255. So we give a further 29,295. Then the working capital requirement by the end of year to increase a further. So we have to give more to make it 118,000. So how much we have to give more? 118,111 minus 80,255. So this makes 37,856. So further this much will have to be given to the project. And then in the year 3, the working capital requirement goes down, means that the business earns some cash out of the raw material and receivables, and it gives back to the company. So the out of this project, the SC company is able to receive some money as the working capital requirement goes down. So now over here, some funds are released, and now the working capital requirement reduces, and 59,150 has been released. And in the end, the remaining 58,961 has also been released. So all of the funds have been released till the end of the year out of the working capital requirement. So once the working capital requirement is increasing, you have to further invest in it. And then when the working capital requirement decreases, you start receiving cash out of the project, and that will be shown as an inflow. So that's the working for the cash flows. And just it will take a minute more and we end the question. So you get the net cash flows. For the years, and now we'll calculate the present values, and the discount rate is 12%. So take the discount rates till 3 places. 1.1 to the power -1, -2, and -3, and then -4. So this gives you the discount fractions for the 4 years time, and then multiply the net cash flows with the present value fractions to arrive at the present values. So once you multiply, you get the present value. And if you add all the present values, you get the net present value. So that's the calculation of NPV for this project of $1 million, and the NPV is positive 90,646. So as the NPV of the project is positive, the project is worthwhile investing in it. Okay, students, please complete this working. I'm giving you around 2 to 3 minutes, and then we will end the meeting, and we will continue tomorrow with the remaining work on investment decisions, and then we will start with working capital requirement, working capital questions tomorrow. So working capital is also an important part of the syllabus. We get a 20-mark question in section C out of working capital, and it can also be tested in other sections as well. So we will do it tomorrow. Okay. So please complete it. People who have not yet noted these down. Yes, the production and sales units were same. Let me answer a few questions which people asked. The production and sales units were same in the question. No, the presentation of workings for section A and B won't matter. You won't be awarded any marks for presentations, and they won't check your presentations. But in C, they will check your presentation. They will check your workings. So if something goes wrong in between your work, you will get half of the marks in section C, but you won't get any mark in section A and B if half of things gets correct, right? Actually, the window cannot be freezed as things have been copied over there. That's why. Kaplan kit is enough. If you do it 2 or 3 times, it will be enough. Yes. Okay, today's topic schedule, I'll show you the bifurcation of our workshop. Investment decision on day 1, working capital management day 2, financing decision cost of capital day 3, risk management day 4, and business valuation and other areas day 5. So this will be the breakup. Moving back to the sheet, today's sheet. Okay, there can be a rounding of difference. Don't worry, Nabil. You will be there is a range of answer out of which you will be marked. You will get appropriate marks unless your working is incorrect. Your working should be correct. Huh? If your workings are correct, you will get full marks. Everyone's answer won't be same due to some rounding of things and all. Inflation rates are different for different products. You must have noted that the prices of tea are rising with a different rate, coffee are rising with different rates. So various ingredients prices are usually different, and in different part of world also they are different. So it can happen. Okay, students, thank you very much. Until now, we will see you in the next session tomorrow. Goodbye. Take care.